she's currently the ex officio board member. Since the pandemic started, we've held several webinars on several topics, and I believe some of you would have joined these webinars in the past. Today's webinar is, however, unique to us, and as you may know, CFA Society Nigeria is one of the member societies of CFA Institute, which is the world's largest and renowned association of investment professionals. The mission of CFA Institute is to lead the investment profession globally by promoting the highest standards of ethics, professionalism, and investment education for the ultimate benefit of society. At CFA Society Nigeria, our mission is really to promote the highest standards of investment practice in Nigeria. So we focus more on our local market here. And we try to provide a vibrant community for our members and indeed other stakeholders in the financial services industry to interact professionally. So I think today's webinar is right there in line with our mission. We recently launched our regulator webinar series, and the intention is for us to use this as a platform to provide an opportunity for our regulators to speak directly to participants in the financial markets. We believe that through this, we will ultimately achieve our goal of promoting a financial services industry, as well as capital markets that are built on trust, on ethics, and professionalism. So I think I'm particularly glad that the CBN agreed to be the first regulator to speak on our regulator webinar series. We will hopefully be bringing other regulators to this platform in the weeks ahead. We'll sincerely like to thank our speaker for today, Mrs. Aisha Ahmad, CFA. As we all know, Mrs. Ahmad is the Deputy Governor, Financial System Stability at the Central Bank of Nigeria. Mrs. Ahmad is a world-class professional. She is a CFA charter holder, and she's a member of our society. And I can say that we are incredibly proud of her, as well as our services to our nation and to our financial services industry. So I'm keenly looking forward to hearing her thoughts on the topic of today's webinar. I'm sure we'll learn a lot from her, and no doubt, I'm sure we're going to have a great session today. So I think my job is just to welcome you and to thank you for joining today's webinar. I'm very confident that we're going to have a productive session. And just to introduce myself, my name is Banji Feintola. I'm the president of CFA Society Nigeria. So on behalf of the Board of Governors, thank you so much for joining this webinar, and I wish you all a productive session. So with that, I'm handing over to Shade Odunaya. Thank you, Shade, over to you. I think we need to get Shade off mute.
Good morning, everyone. Can you hear me now? Can you hear me?
Yes, Shade,
we can.
Fantastic. So good morning, everyone. Thank you so much, Banji, for the welcome remarks. I'm particularly honored and excited to be moderating today's webinar. And as you all know, it's a topic that is in the mind of most people, as evidenced by the fact that we had almost 700 people who registered for this webinar. The title is Nigerian Banking Sector Resilience Amid COVID-19 Crisis and the Role of Nigerian Banks in Post-Pandemic Economic Recovery. So I'm sure you're all waiting, you're all eager to hear what our speaker will be sharing with us with respect to giving us the confidence that this Nigerian banking financial system is going to be resilient, is going to withstand the shock that's hit it in terms of the way the global economy is being affected by the pandemic. And I'm sure that you are ready and eager to listen to her. So I'm just going to read a brief introduction of the guest speaker for today so that you can put things in proper perspective. Banji has already mentioned some of it, but I will just formally go through the entire thing. Our guest speaker today is none other than the Deputy Governor, Financial System Stability of the Central Bank of Nigeria, Mrs. Aisha Ahmad. She is responsible, she is a member of the Monetary Policy Committee and the Committee of Governance of the Central Bank with specific responsibility for financial policy and regulation of the Nigerian banking and payment system, licensing and supervision of banks, non-bank financial institutions, and consumer protection. She's the chairman of the Nigerian Interbank Settlement System PLC, the country's central switch, and she's also chairman of the Financial Institutions Training Center, FITC. She also chairs the Financial Inclusion Technical Committee, which drives attainment of Nigeria's financial inclusion targets. Prior to joining Central Bank of Nigeria, Mrs. Aisha Ahmad was executive director at Diamond Bank and a seasoned financial expert with over 20 years of experience. She's an honorary fellow of the Chartered Institute of Bankers of Nigeria. She has held leadership positions across private wealth, investment management, and retail banking in major financial institutions. Mrs. Ahmad holds the prestigious CFA Charter. As the president has mentioned, she's one of us. And she's also holds this designation of the Chartered Alternative Investment Analyst. She holds a bachelor's degree in accounting from the University of Abuja, an MBA Finance from the University of Lagos, Nigeria, and an MSc in Finance and Management from Cranfield University, United Kingdom. So you can see that Mrs. Ahmad is highly qualified, and given her position in the central bank, she definitely will have a lot to share with us today. You are very much welcome, Mrs. Aisha Ahmad. We're glad to have you with us today. Just as to give you a feel for those who are probably listening to you, like I mentioned earlier, we have almost 700 registrations, and before we started, we had almost 200 people who had logged in. People will also be joining us via Facebook and YouTube, so we're streaming this webinar across those social media platforms. Invitation to the webinar was open, so we have people who are our members, CFA Society Nigeria members, and we also have people who are just working in the financial services system. Anyone who was interested in the topic was allowed to register. So we have students, we have academia. In terms of geography, I'm certain that we do have some people who are joining us from outside the country. So we have a broad-based audience for you, and this everybody is interested in what's happening in Nigeria and want to be able to key in to what's going on. So without much ado, what we're going to be doing is Mrs. Ahmad is going to be making a presentation or giving a keynote address on that topic, Nigerian banking sector resilience and amid COVID-19 crisis, and the role of Nigerian banks in post-pandemic economic recovery. So she will be making the address or giving the address in about 20 to 25 minutes. Then we will take a few questions after that, and then we'll wrap up. We're hoping to be able to finish within an hour. So once again, I want to welcome you specially into our midst, Mrs. Aisha Ahmad, the Deputy Governor, Financial System Stability of the Central Bank of Nigeria. You are very much welcome. And I then hand over to you to give your presentation.
Thank you very much, Mrs. Odunaya. I'd like to just do a sound check with you as the moderator. Can you hear me clearly?
Loud and clear.
And you can see me?
Yes, we can see you too.
Now, sometimes, you know, because when you're giving this kind of talk, sometimes it's one way. So you might cut off and not know you've cut off. So if I've cut off for any reason, please let me know. I'd like to thank you for your kind words, you and Mr. Fentola. In fact, when he said I was a member of the society, I was very happy because yesterday I was thinking, have I paid my dues? Because really, if you're not a paying member, you're not a real member. So I'm glad to know that I'm a full member of the CFA Society Nigeria. So I'd like to now start my keynote. CFA charter holders, distinguished ladies and gentlemen, good morning. I'm very honored to be invited by the CFA Society Nigeria to discuss banking industry resilience amidst COVID-19, a very important and topical subject. The last few months have been a great period of upheaval. COVID-19 continues to unravel itself as a health and economic crisis of what I call seismic proportions with globally pervasive impact. I don't think anyone has been spared really. Individuals, families, businesses, industries, economies, countries, all have had to adapt to what we are all calling the new normal. Global financial markets, the investment and financial services industry in particular, they're important because they're key transmission mechanisms for monetary policy and the deployment of capital. All of these have been impacted. Now, the financial services sector will be critical when the story of this pandemic is told, and for two reasons to my mind. The negative impacts of COVID-19 on the macro environment is a significant potential threat to stability, and it must be managed. At the same time, banks are expected to play an outsized role in facilitating a quick post-COVID recovery, and to do this, they must remain resilient. In fact, the title of today's webinar says it all in that respect. So I'd like to thank the CFA Society Nigeria for providing a platform to share perspectives on these very relevant issues. It is also a good time to acknowledge the significant milestones that the society has recorded over the years. For me, as a charter holder, I think the establishment of test centers in Nigeria is something to be celebrated. As a candidate, I used to be baffled, and I must confess, slightly embarrassed to have to travel out of the country simply to write exams. So I want to say that I'm really proud of the dynamic and gender diverse board of and executives of the society, which was previously led by Mrs. Odunaya and now by Mr. Fentola, who are positioning this society for global relevance. So my keynote is structured as follows. First, I introduce the state of the Nigerian banking sector pre-COVID-19. I enumerate the impact of the crisis on the sector and examine the state of resilience or lack thereof. I'm open to different views about the state of resilience. Thereafter, my paper will highlight some of the policy and prudential measures that we are undertaking to mitigate the impact of the pandemic, and a few key considerations that as policymakers try to implement these measures face. In conclusion, I will try to contemplate the aftermath. And I say try because the pandemic continues to evolve and the economic and financial stability impact as well will continue to change. You can only try to paint a picture of what the future will be. And in doing that, I'll outline the key imperatives for banks, supervisory authorities in a post-pandemic economic recovery. So I'll try and do that within the timeline allotted. Going into the COVID-19 crisis, the Nigerian banking industry has been strong, and we measure strength by positive financial soundness indicators. And we think this is positive because compared to the period just before the most recent crisis that financial industry practitioners remember, the global financial crisis, which was similarly disruptive, the industry is going into COVID-19 with in a stronger position. We've had very healthy prudential ratios thanks to a number of policy measures and reforms. These measures were implemented after the banking crisis of 2009-2010 in Nigeria and the economic recession of 2016-2017. Now, these measures generally focus on addressing the root causes of the crisis. So strengthening governance, risk management practices, improving solvency, And all of this has led to a better capitalized financial industry. Some of these reforms include the establishment of ANCON, resolution of a number of failing banks, adopting risk-based supervisory framework, more cross-border collaboration with supervisors, etc., etc. Things like Basel II and III, and adopting IFRS as well. Now, additionally, a number of deliberate policy initiatives that were aimed at enhancing financial inclusion, particularly developing the payment system through issuances of regulatory guidance. And I think those guidelines and frameworks have helped to bring in new entrants, new products into the payment system. It has enabled our industry to actually leapfrog many other jurisdictions in the area of mobile and electronic banking, with significant investments and innovation in that payments ecosystem. We've seen the growth in value and volume of electronic transactions really skyrocket over the last 10 years. I give an example, NIBS Instant Pay, which is our foremost, instant payment platform, has grown by over 2,000% over the last, between 2012 and 2019. We've seen an improvement in financial inclusion from 47.5% in 2008 to 63.2% as at the last EFINA report in 2018. Now, those guidelines I'm referring to, just to mention a few, guidelines for operating agent banking, guidelines for electronic payments, guidelines for payment service providers, guidelines for mobile money, things like that. Now, it's also pertinent that I mention, in addition to that development in the payment system, that prior to COVID-19, the financial services industry itself was experiencing rapid transformation. Those within the industry are aware of this disruption. I've talked about new players and how deliberate policies have attracted those new players, new products, new channels of deployment. The increasing use of mobile as a key channel by traditional financial institutions and the newer ones has completely radically changed the ecosystem. So we've seen that in mobile payments, I've talked about payments, merchant acquiring, digital lending, and the general shadow banking space. And this has been in response to digitalization, technological innovation, and frankly, changing customer needs. So whilst this, like I mentioned before, has sort of enhanced banks' capacity to deploy their financial services, we are seeing banks deploying chatbots, for example, and the whole transformation of the service delivery mechanism online. It is also bringing to fore operational and cyber-related risks that arise from connectivity to third-party providers, because a lot of banks are outsourcing some of these key functionalities, integrating, because as they collaborate with other players in the financial system, they have to integrate, and that integration can be a source of risk, the use of cloud computing, and all of those things. So this sector is no stranger to disruption. And you may say that, you may be forgiven for saying that it brings with it the experience of adapting to significant change. Now, notwithstanding this dynamism that I have described, the banking sector faces significant headwinds due to COVID-19. The Imf Economic Outlook for June 2020 forecasts a contraction in both global and domestic output by 4.9% and 5.4% respectively. Key issues that as industry professionals we may be aware of, like the crash in international crude oil prices, the disruption in global value chains, the reduction in domestic economic output. Of course, due to muted business activity during the lockdown, business activity is restricted. The external sector pressure on the exchange rate and the general macroeconomic uncertainty. All of these things have potential negative implications for the banking sector if it is not well managed. Also, the banking sector is operating within a macroeconomic environment. Key customer segments and industries to which this sector is exposed, such as oil and gas, manufacturing, airlines, and tourism, have also been severely impacted. For example, given the significant contribution or the significant exposure of the banking industry to the oil and gas sector, which is responsible for about 40% of industry credit, and the fact that we have another, say, 40% percentage of loans that are sort of provided in foreign currency, it gives you a feel for the potential risk in this respect. I say potential because later on I will discuss the existing buffers within the industry that sort of shield it from these risks crystallizing. So in summary, let me say that the sector faces heightened risk from the weaker macroeconomic environment. There is operational vulnerability due to the increased use of digital channels for financial transactions. When we're all locked down, we were using mostly online and mobile related channels for transactions. That comes with it some risks. And of course, remote working, even as financial services was designated as essential service, most of the banks were advised to move to their to trigger their business continuity plans. So there was a limited availability of staff on ground, of course, to protect those staff as well from the health risks, and of course to align with the requirements during the lockdown. All of these things have implications for trade transactions, for asset quality, cybersecurity, the operational risk profile, the operational cost profile. People following the banking industry understand that the cost to income ratio within this industry has remained traditionally high, even as the CBN continues to encourage shared infrastructure to reduce the average cost of deploying these services. And these effects I have mentioned is further compounded by the significant reliance on this same industry by the domestic economy to continue to channel credit to the economy, to continue to maintain payments infrastructure, and to preserve banks' own financial sustainability, to ensure they protect jobs and continue to contribute via CSR to the host communities in which they are. In spite of all of this that I have described, the banking sector continues to have positive soundness indicators, strong capital adequacy, liquidity, and asset quality. For instance, the sector total assets continue to grow at an average of about 25% year on year as at June 2020. Capital adequacy is 15%, which is much higher than the 10% international benchmark and compares favorably with other countries. The liquidity ratio is quite robust at almost 40%, which is higher than the minimum requirement of 30%. And we retain adequate buffers because the industry CRR balances are high, and that provides ammunition to provide liquidity backstops if required, if that happens to be needed. The NPL ratio as well has declined significantly. I think it's important to mention that NPLs were, double digits in 2018, and today they are single digit. Return on equity in Nigeria has always been impressive compared to its peers, 20.5% on average, and that has been sustained, higher than 12.8% in Turkey, 16% in South Africa, etc. I think one other important indication of resilience has been the fact that the banking and payment system, it retained its operational strength during the lockdown. We maintained availability of electronic payment channels, despite the fact that these transactions increased, I think, over 400%. We had over 400% in agent transactions. I asked for that data today because I recall having a previous conversation about how the agent networks were utilized during the lockdown. It would be irresponsible if I do not mention that the lockdown also revealed some residual weaknesses in financial inclusion, particularly low adoption of digital financial services among certain segments of the society, low income rural dwellers, and just others that are included in the financial system but have been slow to adopt those digital channels. But the payment system and the ecosystem is already mobilizing resources to resolve the challenges, because the way the market sees those challenges is as opportunities. And so we are seeing increased collaboration between banks and all of these other players to resolve those challenges. So in short, the system has been very resilient through this pandemic. Now, you might be asking, what is responsible for this resilience? What is making the bank strong? The first reason is that I mentioned earlier, post-global financial crisis, banking sector is more liquid, better capitalized, which means you have more buffers to absorb any risks that are crystallized. That's first. Secondly, a few existing policy initiatives that were designed to stimulate fragile growth. I have a limited time, so I didn't want to go into the history of exiting recession in 2017 and how growth has been positive but has been fragile. At the CBN, we could see that there was need to ensure that we further improved and accelerated banks channeling credit to the real sector. And that was what led to the birth of the loan to deposit ratio policy, which incentivized banks to increase their lending to the real sector, particularly areas of agriculture, manufacturing, and retail. That policy has been very successful. Since May 2019, since it was launched, we've had a growth of about 3 trillion in new loans, in net new loans. And a significant part of it went to consumer, manufacturing, and all of those sectors I mentioned. The Global Standing Instruction, it's a policy that has helped to resolve some of the risk appetite problems that we have in the industry. So it is one thing for banks to have the liquidity to lend, it's another thing for them to be willing to lend, given some of the challenges and experiences they have had with recalcitrant borrowers. So the Global Standing Instruction just allows the industry to hasten repayment and assure repayment for those obligors that are not willing to repay. And then the payment system initiatives I've talked about. Because all of these things have created precious industry momentum, right? You're already on a trajectory, trying to stimulate expanded credit, trying to stimulate activity in the real sector. Now, entering a pandemic within that trajectory gives you a quicker response time. All you just need to do is really ramp up what you are already doing. So that's the second critical success factor. The third one is proactive fiscal, monetary, and prudential policy responses that have helped, buffer the industry from those externalities. It's like bought us some critical lead time and preserve financial stability thus far. I want to quickly go over those. So globally, all of these authorities I've talked about, fiscal, monetary, prudential, have introduced several policy measures to mitigate the impact of the pandemic. If you do a study of the various measures, and I've seen a lot of PowerPoint packs that looks at measures across countries, very easy to find. They're pretty similar. It's around providing stimulus, providing support to industries that are most affected, by the pandemic, and preserving jobs and things like that. On the fiscal side, I think we set up the Nigeria's Economic Sustainability Plan, detailing our own stimulus and including a public works program that's supposed to create at least 1 million jobs. On the monetary side, amongst other things, on the monetary side, we reduced the MPR notably. So I'm talking about some of the key issues. We reduced the MPR by 100 basis points because we recognize that even though financial price and monetary stability is sort of the key mandate, given the sudden pervasive impact of the pandemic on the economy, it was important to also focus on what we could do to, reflate the economy. And that led to the reduction in the MPR by 100 basis points from 13.5 to 12.5, and a host of other stimulus measures, such as, the targeted credit facility that was to support the households and small businesses that were most affected. As at the last count, I think 95% and above of those funds have actually been disbursed. Let me talk about the prudential measures, because those measures more directly sort of impact the financial system, and it keeps me on topic. To sustain the banking sector resilience, we supported some of the fiscal and monetary measures with a number of prudential measures. Apart from telling banks to trigger business continuity plans, we issued guidelines for regulatory forbearances. And we granted banks the leave to restructure credit facilities for obligors that are most affected. I mentioned some of them. Certain households, certain small businesses, particularly those that are in the informal sector, oil and gas, manufacturing, transportation, tourism, government, all of those sectors. And the reason why we issued guidelines was to ensure that there were standards for applying those forbearances, that it was orderly, and that there was some thinking around which sectors would benefit. And also it gave a platform or principles for underwriting. Which kind of loans would you restructure? Would you restructure loans that have no security or not? Would you restructure loans that are already expired and things like that? We did enhance stress testing. We always do stress testing, but clearly it was important to specifically dimension what the impact of the oil price, the impact of the macro environment was going to have on the banking sector, first on its loans and on its resilience. We also enhanced the framework to include some new macroeconomic and financial forecasting issues to see how, because in the past, we've always been able to do, should I say, single focused stress tests, over time. It was important to then sort of model if everything was happening at the same time, which is what is happening with COVID-19, what would be the impact? And of course, it's an iterative process. We also came up with a new FX monitoring template, because whilst we didn't really have issues with local currency liquidity, and that has also been an advantage due to some of the actions we took in the past. The streamlining of the OMO market has created significant liquidity for the banking system. So the liquidity issues sort of that would typically be there in a situation like this were not. But the FX side was different. We thought it was important that we should look at both contractual and behavioral maturity mismatches on the FX side. So we created a new template for that banks have been submitting regularly. It was also important because under IFRS 9, when you are using an expected credit loss model, you are meant to estimate, right, what you think the impact of the environment or the company's unique situation will be on the asset. The IASB's guidelines on that was that because of the high level of uncertainty of COVID-19, it sort of gave banks the impetus to sort of determine what that would be and kept it flexible to change because the impact continues to evolve. Other jurisdictions deployed counter-cyclical measures. So things like, releasing capital buffers, reducing general provisions and things like that. Whilst we support that, we are yet to deploy those. We are keeping them as ammunition because the current system is very resilient and we have robust capital buffers thus far. However, should things change? Should we have a second wave? Should there be a failure or, a long time to develop the vaccine? Things could change. Whilst we are cautiously optimistic, we remain very, very vigilant to ensure we are preserving this stability. Now, as I round up, I want to talk about implementing the policy measures, some of the key issues we went through. I'll just list them so that I can go into the final section, which is the imperatives for the banking system. Of course, you have to balance conflicting policy objectives. I mentioned one, which was, well, not quite conflicting. No, price stability growth is not quite conflicting, but one has to take precedence over the other. You also have to focus both on preserving stability and ensuring credit growth. Sometimes these two can be in conflict because some of the policy measures, if you want to really uphold the prudential discipline, will restrict you from, credit growth. So policymakers have to make decisions, important decisions around that. I talked about the framework. It's important to have a framework. And within our own framework, it was important to make these forbearances time limited and dependent on the trajectory of the pandemic, because should the macro situation improve and businesses, start to retain cash flows pre-COVID without us, rolling back those forbearances, you have exposed the industry to the risk of default. We also needed to consider the impact of export restrictions, because after this early days of this pandemic, we found a number of countries start to restrict exports of certain key inputs that are critical for other countries to stimulate their own local production. Now, if that persists, it may restrict the ability of the companies we are giving these forbearances to actually make use of the time. What's a forbearance? Is giving you leeway, given the current circumstances, for the business to recover. So those are things that we needed to consider. And then, of course, obviously, ensuring that we manage the potential credit impairment. Because if we are, extending facilities, then it will be important to ensure that at the time when they crystallize, the expected level of impairment of the portfolio is retained. Those are some of the trade-offs and some of the considerations that policymakers sort of in the prudential space have to consider as they try to, balance the competing priorities of preserving stability and ensuring that the financial system plays its role as a supporter, of the broader economic recovery. So I'd like to just end with, the imperatives for the banking sector post the pandemic. A picture of the post-COVID economy cannot be painted with any certainty. I think I've said that several times, given that the impact continues to evolve. However, there are a number of developments that have already manifested that we can safely say will persist as the global economy recovers. One, the new normal and the migration to digital financial services and remote working. In the past, that wasn't a thing in the banking industry. I worked in the banking industry and it was not a thing. But the expectation is that given the current high cost profile and limited revenue opportunities, financial institutions may start to see the value in reducing sort of their physical investments in deploying their services. A radically altered financial industry landscape is here to stay. Pre-COVID, we had that. COVID has thrown up certain opportunities in the financial space, which will attract even more new entrants. The disruption in the global trade framework, the increasing unilateralism as countries continue to see value in protecting local production efficiency, reducing their reliance on other countries for inputs. It is expected that there might be some global investor apathy and risk aversion, and this has implications for debt capital and funding for banks. The muted macroeconomic environment and the recovery. If the global financial crisis is anything to go by, I think it will take a while before the global economy rebounds to the pre-COVID levels. I've heard analysts, argue that we never really recovered from the global financial crisis. This is pervasive, and all around more comprehensive, so that would be a consideration as well. And I think, to be fair, practitioners should expect a more intensive regulatory environment. It's been intense, but now regulators as well have to start to deploy artificial intelligence, reg tech, sub tech to enhance their own supervisory capability, because they have also had to change, their supervisory framework to align with the current reality. So having said all of that, in terms of what I think, we might see in terms of post-COVID picture, the Nigerian banking industry will remain central to any post-pandemic economic recovery. So what should be the key imperatives for both the banks and the policymakers? First, the banks, you must embrace the new normal. I've said it before, drive productivity through remote working. The lockdown period showed that this could be done because we preserved access to financial access whilst we were working remotely. So it's something we can do. We must support the fragile economic recovery, channel credit to priority sectors, agriculture, manufacturing, small businesses, and also the sectors that appear to be positioned to take advantage of the new normal: telecommunications, education, technology, and the like. On the regulatory side, we'll continue to support banks and incentivize them to lend through the LGR policy, the GSI policy, the collateral registry, anything we can do to reduce the risk that banks are taking in terms of the lending, to improve their risk appetite to be done. Banks must preserve their prudential, they must present resilience. They must just preserve resilience. On the prudential side, to keep the prudential metrics healthy, as I mentioned. On the operational side, to manage cybersecurity risk, operational risk. On the financial side, to actually ensure that they are returning the revenues that will be required to build those capital buffers. So look for new opportunities in the market, etc. Banks must collaborate within that competitive landscape I described, and probably rethink their role in that industry, because I see banks as an important source of support for the regulator from a financial stability perspective, particularly the insights that banks can give on the shadow banking industry. And collaboration would also help them focus on their own core strengths and act more as a stakeholder that drives market discipline. And regulatory authorities, of course, would have to reassess the toolkit that we have and the rule book. Sometimes in crisis, you have to almost radically change, most of what, is being contemplated. But thankfully, all the actions we've been taking in the past have positioned us appropriately to achieve that. And would, try to leverage a lot more on technology in deploying those supervisory tasks and regulatory contemplations. So in conclusion, this is an unprecedented situation, crisis. The health effects, the economic effects are still unraveling. We are expecting the banks going into this have been very strong and thus far have remained resilient, and we expect them to play a really outsized role in the recovery, which I strongly believe they are positioned to do. The regulatory authorities must, maintain balance between the competing objectives that are presented, particularly vis-a-vis stability and growth. And there must be increasing engagement between the market and the regulators, between the regulators themselves from a cross-border perspective, to enhance broader learning as this pandemic unfolds. So for the Central Bank of Nigeria, in furtherance of this financial stability mandate, we will remain committed to preserving the industry's ability to play that intermediation role we expect it to play. And we will support the sector resilience that we have currently, always in pursuit of, all the credit, all the policies, the initiatives, the frameworks, is really to support that inclusive growth, sustainable development, and the well-being of every single citizen. Thank you very much for listening.
Thank you so very much, Mrs. Aisha Ahmad, for such an insightful and comprehensive presentation on the topic. If you look at the topic again, which I just mentioned, you would see that Mrs. Ahmad has done an excellent job of covering every area. The topic is Nigerian banking sector resilience amid COVID-19 crisis and the role of Nigerian banks in post-pandemic economic recovery. So I'm sure that you would agree with me that, she told us that the sector was strong pre-COVID, and because of policy measures that had been undertaken before COVID, it put the sector in a strong state when the COVID hit. And even now, in spite of the COVID, the prudential parameters and indicators are still healthy, and there is a buffer that is being retained in case things go into from bad to worse. We were all hoping it wouldn't. We're hoping that the global economy will eventually pick up, and the Nigerian economy in particular will be able to rebound. Now, we do have questions. I know that we had made a commitment to finish within the hour, so I'm going to crave the indulgence of the Deputy Governor, Financial System Stability, for a few extra minutes on the hour so that we can take a few questions that have come in. Of course, there are loads of questions that came in, and I'm just going to try and take maybe like 2 or 3 quickly, and then we'll round up. So I'm going to read the question out as it's been given to me. Can you please talk a bit about the global standing instruction policy? How is it going to strengthen financial stability? And then, does the policy extend to non-bank financial institutions, asset management firms, trustees, custodians, etc.? And are the assets held in other sectors, are they going to be covered? People are just wondering, especially since we're investment management professionals in the main, that this global standing instruction policy, is it going to flow into the asset management industry? Could you respond to that, please, Mrs. Ahmad?
Okay, ask me 2 questions, and I'll answer the second one first because that's the easier one. It doesn't apply to assets outside the banking industry. So it wouldn't involve those assets that are managed by investment managers, except they're in a bank account and the owner of the bank account has actually signed an agreement with the bank that they can use the funds in that bank account to settle any obligations. How would it preserve financial stability? I was rushing through the keynote, so I couldn't really go into some of the challenges that the industry has faced over time when it comes to recovering bad loans. We all know the impact of provisioning, particularly loan loss provisioning, when loans start to go bad, on banks' profitability and long-term sustainability. That has put us in the past in a sort of negative loop where the primary role of a bank is intermediation. Yes, you can make money from enabling payments, transactions, trading in securities, etc. But the primary role is intermediation. Now, if banks are tentative in lending, there's a knock-on effect that the the real economy is starved of credit. And without the kind of funding, that supportive funding, of course, we need all kinds of capital. There's the role of equity and there's also the role of debt. When that debt capital that the industry requires is not there, we will not see the GDP growth that we need. And if we do not see the GDP growth and activity that we need, the macro environment that the banks themselves are working within becomes unfavorable. So it's very, very obvious that, of course, we cannot address all the risks to do with lending, because if there was no risk in lending, there would be no return, right? This is a CFA platform. It's one of the things we've learned. So it is to reduce the risks that are avoidable that would allow the institutions to focus primarily on the structure of the business that they are trying to support. They shouldn't be worrying about whether, okay, even though there'll be cash flow, this business would like to divert funds, right? So that's the whole idea about the GSI policy. And the customer would have to agree. You know, I've read some reports around debiting people's accounts. No, when you take the loan, you'd actually sign that. You agree first that you will repay the loan. It seems a bit obvious because the expectation is that if you take a loan, you repay, but here we go. You agree that you repay, and you agree that should you not repay, and should you have funds in the market, we will scan the entire industry for funds that, you know, that you hold for the repayment. And that's really what the GSI policy is about.
Thank you very much for that response. So the GSI is supposed to protect the system and ensure that the banks can focus on lending and not be worrying too much about someone hiding money somewhere. I will take a second question that says that there is no doubt that inclusion of more citizens in the formal financial system is needed to ensure sustained economic recovery post-COVID. What are the CBN's policy thrusts in this regard? Just like you to mention the specific policy thrusts that would ensure and assure that financial inclusion continues to grow.
Okay. Thank you for making the question, you know, because there's a lot I can talk about when it comes to financial inclusion.
Yeah, just some.
Many milestones sort of have been achieved, you know, since we started the journey when we signed the Maya Declaration. I think the first thing would be creating an enabling environment, you know, giving clarity from a regulatory perspective to market players, giving appropriate licensing, you know, and as the industry evolves, providing insights and guidelines to encourage innovation, and that innovation is required to continually make deployment of financial services cheaper and the inclusion of everybody else, because we tend to think that financial inclusion means you need a bank account. But we would like to think that the ecosystem has diverse stakeholders within it that have different needs. So that innovation, that competition is meant to ensure that every individual in Nigeria gets access to financial services that is appropriate for that individual. So that regulatory framework is the most important thing. We want there to be more efficient service, cheaper service, and robust electronic platforms. You know, so anything that encourages digital financial services is something that we'd like to promote. We want to support the stability of the system, because we recognize as regulators that as we bring in new entrants, new technologies, interconnectivity, those come with certain risks, and we need to balance, you know, the risk view with the market development view. You know, part of the trust includes strengthening literacy and education. I give you an example about what happened with the lockdown. So whilst people assume that, okay, it's people that are excluded that don't have digital financial services, even those included are not using those channels. How can we, you know, encourage stakeholders to know, our users to know that what is available in the market. This is such a well-developed, for want of a better word, system where we have deployed, artificial intelligence, to make credit decisions. We are using chatbots to engage customers. There's a lot of stuff happening in this market. And we would like to challenge banks to start to think about what is the level of adoption. If you have 1 million customers, how many of them are on the mobile app? How many of them are online? How many of them are engaging with you on alternative channels? And then, of course, I think the final thrust would be maybe promoting shared infrastructure, common payment infrastructure, which will dovetail into, cheaper operational costs, and also promoting interoperability to ensure that it's very easy for customers to access networks. And that's where we are being very strategic about investments into the industry. There's no point having multiple players creating the same platform when we can have interoperability that connects us all in there.
Fantastic. You see, we could keep you forever, but we have to keep our word. There's so many questions that have come in, and I'll just ask one last one as a parting shot, simply because I know it's also something that is dear to you. Several analysts and public interest groups have advocated more female gender representation in leadership positions post-COVID, given the performance of countries led by females in managing the COVID scare. So the question is, what policies is CBN putting in place to promote women to the C-suite in the banking industry? I say it's a parting shot because I know that
I would have been surprised if that question did not come. Yes, I think I agree with that question, the way you've put it. I think the pandemic has also spotlighted what effective leadership means in a crisis. And in, evaluating that women have come out on top, certain countries. I think New Zealand was mentioned. I think those female-led economies, New Zealand, Germany, and how they manage the COVID-19 crisis, Well, I think women have always known this, so we're glad that the world's waking up to it, the capacity for female leadership, but it's not really restricted to female leadership. So if you look at some of the traits, that I think, the articles that looked at the performance of these women focused on, it was the ability to take bold action, the ability to consult and get, several views, the ability to be inclusive and diverse, the ability to be forthright and present, in a crisis. These are things that we can all adopt. So it's not really restricted to women. It's about what is effective in a crisis and going out of it. But from a CPM perspective, we've always advocated for certain percentages of female representation in senior management and the board. And we continue to engage the banks and follow up with them in terms of their returns in that respect, showing them that we take this very seriously. We think that also gender disaggregated data will be very critical, because what you don't measure, you can't focus on. And so, encourage institutions to continue to review across all their products and services, what level of diversity exists in there, and not just gender diversity, all sorts of diversity. I think inclusion is a big topic, that can have a lot of social, positive social advantages if we focus on it. I know that recently, from a financial inclusion perspective, there was a study that was commissioned by EFINA on women's financial inclusion and what financial institutions can do to further, bring them into the financial system. I think that will be launched sort of very soon. And I think a combination of all of that, should continue to position female leadership, from a career, entrepreneurial and financial inclusion perspective. I'd like to thank you so much for this opportunity.
We should be thanking you. We wish we could keep you, like I keep saying, for longer, because the interaction has been very engaging and enriching. So I would like to say, on behalf of the Board of Governors of the CFA Society Nigeria, I wish to express our gratitude to you, Mrs. Aisha Ahmad, for honoring our invitation and for providing us with so much information and confidence and assurance that the Nigerian financial system is stable and everything is being done from the regulator perspective to assure its resilience in spite of the pandemic. Thank you so much, Mrs. Aisha Ahmad, and we hope that the next time we'll call you, because we definitely will call you again. You would honor our invitation and you would respond positively to us. I'd also like to thank the Deputy Governor's team that supported her in ensuring that she showed up, because I know that she definitely needed her people also to help her put things together and to ensure that today holds. So we want to say thank you to you, especially Mr. Chibuike. I want to make sure I get the surname right, for assisting and supporting the Deputy Governor. I'd like to thank everyone who has joined us on this webinar. I'm sure that we didn't answer all your questions, but you know, we don't have all the time either. There were too many questions. But I'm certain that you took a lot of insight and learning away from what the Deputy Governor shared with us. And you can go back and review the banking system and your valuation for the banks and use this information and put it into perspective for you to do your projections for going forward. I'd also like to thank the Programming and Advocacy Committee of the CFA Society for putting all of this together. I'm sure that we will all survive the season. So let's all continue to keep safe and stay healthy. And very soon, we believe that the tide will be over and the economy will go back to, will go on the path of growth on a sustainable basis going forward. So at this juncture, I would like to say thank you for everyone that has been on the webinar. We will be sending you a feedback form. Please, would I like you to please complete it. Your feedback is very important to us. It will enable us plan the next webinar and improve on whatever we have not been able to do excellently this time. To all of you on Zoom, YouTube, Facebook, wherever you have joined us from, we say a very, very big thank you. And we hope to see you again very soon. Have a very great afternoon, everyone. Thank you so much, Mrs. Ahmad. It was an excellent.
Everyone keep safe. Yes, yeah. Thank you.
It was an excellent presentation. So insightful. Yeah, thank you so much.
All right.